Patrick, you guys ready to start with interest rates? So exciting. So our theme in 2025 was that the 10-year Treasury, which is what matters, the 10-year Treasury controls mortgage rates, everything, that it would be range bound between basically 4 and 5%, that interest rate sensitive investments, real estate trusts, things of that nature, Treasury bonds, would be accretive to a portfolio in that environment. That's basically what panned out in 2025. We had a couple little scares in April and May around the tariff tantrum of rates rising. We're starting to have that again now. The bottom line is that for the last few years, what's been happening in the rate space is that we've been able to stay in this GoldiLocks zone of 3.8 to 4.8%. So this is what we showed in our last event as far as what we call the GoldiLocks zone. The thing about interest rates is if they can stay in a range that's predictable, markets stay in equilibrium. That's all we care about. And so that's what's been happening here. So now let's fast forward to today, because this is the same chart. What you're seeing here tracked it from 2023 to 2025, the 10-year Treasury. So that's a couple years. And then now I've shrunk it up to just being the last year. So from January of last year, January of this year, you can see how the 10-year Treasury has been predominantly within that GoldiLocks zone. And then we have this that happens just recently in the last couple of days. You've had this consolidation pattern that's gone on at the bottom end of the range for a few months. And then now you've got this little pop up. And why does that matter? It only matters and it only raises concern because a lot of people set up algorithms, they set up their portfolios in certain ways. And if money managers were really betting on the Fed's going to lower rates, interest rates are going to go lower in 2026, and they were betting around that and positioning, they would prefer that this would have rolled over and started to head lower. So the fact that it popped up, it causes certain allocators, certain people, the way they were leaned into their allocation, to have to readjust. Because what ends up happening is when you have this kind of breakout, where you see that red X, that now becomes the target. It's basically 4.5%. So is it a big concern? Not really. I mean, this is like stubbing your toe, right? You're at the beach, you stub your toe. Yeah, it sucks, but nonetheless, it's not going to derail your trip. So getting above 4.5%, that's the line that matters right there. Like most people's systems are built to withstand the 10-year Treasury and getting to about 4.5%, much above that. And if it starts to look like it's going to get above that, then I think you start to see a little more disruption in the market, because most likely, if you get that kind of strength in 10-year Treasury, it means you're probably getting strength in the dollar too, which would jeopardize possibly the metals trade, and possibly you could create some volatility in the market. So this is worth watching after 6 or 8 months of, lulling us to sleep. Interest rates now are worth talking about. It's coinciding with kind of a global move. So this is why we started with saying, hey, revenge of the rising sun, is because Japanese yields are having their 2022 moment. So Justin, Patrick, why is it the 2022 moment? Because this is what happened here in the US as we came out of COVID. Our interest rates went from basically 1% to 5%. Boom. If you remember, everybody was like, oh man, let me buy government bonds because now the yields are high, blah, 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 blah. So Japan's going through the same process. With all this hoopla, they're at 2.8%. So they've had a historic rise to 2.8%. Now, granted, they started down here. This chart is 5 years long, so you can see they started as basically at zero. So running up to 2.8% statistically is a pretty big deviation and move. So you can see it's gotten parabolic. And why does it matter? Well, if you go to our blog, The Next Wave, and you just look back a couple publishings, you'll see what's the yen got to do with it. And we talked in detail, as simply as possible, within 3-4 paragraphs, We told you what the yen carry trade is, how it works, and why it matters to markets. So I highly, highly suggest that you read it. But all you got to know is that what people have been doing for many, many years, 30, 40, 50 years now, is that while interest rates in Japan were at zero, you could go borrow money in Japan at a zero rate, take that money, come over to the US, and just buy a treasury bond that pays 4%. So just think about the arbitrage. You borrowed at zero, or let's call it 0.25, and now you put it in something that's earning you 4. That's a treasury bond with zero risk, and your biggest risk is the currency, and you got that spread. That's been going on for years, and it's a source of liquidity. People make money from that. They take what they earn from that, and they go buy Nvidia. They go buy this. They go buy that. They take that money and you leverage it. So it's just a free cash cow that now has to be unwound because you cannot now go buy or borrow in Japan at zero. You have to now pay 2.8%. And if you go borrow at 2.8% and park it in a U.S. Treasury at 3.8% or they're 4.25 now, right? At 10-year, it's not a big enough spread for the currency risk. So it starts to unwind some of the liquidity in the market. It trickles over into stocks. It will go. This will happen through phases and cycles over the next couple years as Japan goes from deflation to inflation, and it does have an effect in our world as well. So that's what you need to know. I'm going to open it up, gentlemen, for you guys to ask me some questions. But I think the bottom line on interest rates, and please challenge it, please think of other things, is that the zone to watch is 4.2 and 4.5. Like we're right in that, because below 4.2% on the 10-year, market's got equilibrium. Interest rate sensitive investments still do okay. Nobody gets upset. Above 4.5 and markets start to get a little wonky if it's by surprise. If they got time to adjust, it'll happen, but it could put a lid on some potential risk taking as we move forward into the year. So let me pause and open it up for you guys to throw in what you think or see or hear.
Well, you said the tide was shifting at the beginning, and it's not because we're still in the range that you talk about. It's the speed and how much the rates have gone and changed. Because on average, 0.1% in the 10 is of 10-year interest rate is what, about a 1% shift in bond prices. So you talk about the yen going from a 1 to a 2.8, that's over a 10% drop in bond prices. Even ours in the last 2 days have huge swings in the interest rates. That volatility is not good for stocks and going forward. So is that kind of what you're getting at, that the tides are shifting?
Yeah, what it is that you have a lot of people. When I listen and hear people talk about the markets, a big narrative that I've heard across the board that I've been not necessarily I've been indifferent on is this narrative that, oh, you're going to see interest rates go lower. Trump's going to get a new Fed chairman. The Fed's going to be more dovish, and we're going to see lower rates. And there's I think most guys in our business that are advising other people have been on that team, and so the market now making this quick move like this gets people off centered. Like they're like, oh shit, I didn't expect that play. And so, I just think most people were positioned for lower rates. They're not positioned for this. I don't think anybody's really positioned to get above 4.5%. And because they're so focused on the Fed and how rates could go lower, what my concern is that it's hard for rates to go lower if you have, the largest part of the population that's growing is 85-year-olds, and they got money. And so like baby boomers are aging. They're not dying. They're not dying at 60 or 70. And then when you look at all these medical advances, everybody's living to 90. Okay. I mean, even if they don't want to, and they got money. And then you have the Gen Xers that are a small population, cynical as hell, but they now have some money and they're coming into times of money. And then you got the millennials, and they're a huge population and they want houses and they got money. Because half of them lived at home forever, and then the millennials have some fat 401ks, and they're ahead of everybody else in their financial knowledge and things, and they got better tools. So when I see all these things coming together, it's just like that's growth. And growth means higher interest rates. That's not something to be scared of. We should be proud that we're seeing growth in the economy, and it just means you got to make sure your investments and your portfolio and your income are growing. Like, don't be afraid of it. Just make sure you're making money along with everybody else. So I'm not into that narrative because I just don't think the demographics support it over the long haul. It might work for 3 weeks, months, couple, Trump might get his way for a year, but I don't think it goes for 5 years. And so, I think the more you stay in this range, the more of what I'm talking about starts to become aware with people. So as long as we can bounce around here for years, even if we go up into this range, if it takes months to get up there and break above it, the market won't freak out. But to your point, Patrick, if it happens fast, look at this. If it's like a Japan chart here, where you get parabolic. I mean, this is like 1 month right here. It just boom. Like this was all resistance, 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 and then smack. So if you get that happening in the U.S. above 4.5, so imagine that this is 4.5% right here in the U.S. If you get this later this year, we just boom, 4.5, boom, 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 and then pop, we're into 5.25, and it happens like that. Then yeah, that might be disruptive. We'll cross that bridge when we get there.
Yeah. But it's funny when you say that, baby boomers, largest population, spending all the money. It's why we like healthcare as a sector, because where's 30 to 40% of their income going to be going into healthcare?
Yeah.
To keeping them to the 90.
I'm sure you guys tell clients the same thing I do. We sit down, we look at their money, and I say, most likely, most of this money is going to get spent on healthcare, and then it's going to go to the next generation. So make sure you got enough for healthcare. Yeah. So that's that's where we're at. Justin, you got anything what are you got any thoughts or feels, or are you hearing anything from your clients about interest rates?
I guess I would just ask, your question to you would be I know we'll get deeper into the conversation around metals coming up, but the whole idea of the yen carry trade, banks, people borrowing 0%, putting it over here and then leveraging up. I've been hearing some chatter about some of those people buying, and basically shorting the silver market, the gold market. And then now with this coming in, they're having to unwind those positions, which throws gasoline on the fire.
Yes.
And
yeah.
Do you think that, is that, I mean, I guess it's probably part of it, but how much of that do you think is part of this overall move with the kind of the yen carry trade and then the uptick with yields?
Well, if you would have asked me that question a month or two ago, I would have said to you, probably a small amount. But the amount of squeeze, like when you look at silver, a chart of silver, I have one later, or a chart of like silver miners, and you see how they've just exploded higher. It leads me to believe that it's bigger than I thought, because you don't get those big explosions without a lot of short squeezing. So I do think you have quite a few hedgies and hedge funds. I don't know why they would be short silver. Maybe because it was just lulling everybody to sleep for 4 years. But boy, when it moved, It sure did. And now you're seeing it in natural gas. You have the same thing happening in natural gas. Funny part with natural gas is it's up like 40% in like 3 days, and it's right back to where it was a month ago.
Part of that's because of the weather rolling in, though, isn't it? Like people are.
Yeah. Well, you got the weather narrative, which just tells you how thinly traded that market was.
Yeah.
Everybody's in stocks, nobody's in commodities. So which why I believe commodities are now in a secular bull market. It's not just gold and silver. You're going to see this rotation through other areas, which we'll talk about in a second. All right, so I'm going to move on if you guys are cool with that.
Yep.
For everybody, if you're wondering, well, what the heck is a rate-sensitive investment? Well, so the poster child for rate-sensitive in a negative way, is Treasury bonds, meaning that if interest rates go up, you really don't want to own a Treasury bond fund. The other thing that can be rate sensitive is traded REITs or mortgage REITs. They've gotten a little bit of a reprieve in this because Trump came out and said they wanted to spend $200 million or billion on buying down mortgages. So that's helped a little bit. But the traded REITs and mortgage REITs are an area that I would be a little concerned with now that the interest rate environment has changed a little bit. Utilities can be rate sensitive, but right now they're kind of trading more on an AI trade AI and the electrification of everything is causing so much electricity demand. Like if you look at what's the electricity demand from now to 2030, it's like a hockey stick. So utilities are in the driver's seat right now as far as pricing. And then things that can also be have relative underperformance with rising rates can be high dividend equities, consumer staples, telecoms, AT&T, Verizon, things like that. And then, what's a good hedge is there are some rising rate ETFs. I can't give you the symbol because then I'd be talking about a security. But if you want to know a good hedge for rising rates, then reach out to us and we can give you some ideas because there are some stuff that can make money if rates rise. So let's move on to equities, gentlemen.